Well, welcome everyone to tonight's monthly event of TIE. You know, and I'm curious, how many people are here for the first time? Okay. Good, for everybody, maybe about a third of the group. Well, let me take a minute here and chat with you a bit about TIE before I introduce tonight's event. TIE is an organization formed in 1992 in the Silicon Valley area by a group of individuals from the Indus region, which is a river that runs through India and Pakistan, with the goal of giving back to the community and also kind of their local kind of ethnic group, helping them get started with their businesses in America. You know, since then, the organization has grown. It is now comprised of about 13,000 members and 56 chapters in about 13 countries. It is the, you know, I don't know if there's a verifiable fact, we consider it kind of the largest worldwide organization of entrepreneurs. The local chapter here was formed about 12 years ago. In fact, the individual who formed it, one of the charter members is here tonight, Suren Dutia. And Suren, if you wouldn't mind raising your hand. Thank you, Suren. Suren was critical of the founding of the group and went on to become the chairman of the global group for about 3 years. So very proud of the organization we have here and proud of the leadership. So TIE is its mission is to give back. They give back in 3 ways, and that is through mentorship, education, and networking. So tonight's event, as you saw, we have a nice period of time for networking, about an hour and 15 minutes. We have a wonderful Indian dinner, which is a reflection of the heritage of the group, of the founding. So I hope you all really enjoy that, as well as that great chai tea. You know, the organization is much more inclusive now than I think it was, but I think what really makes us distinct and unique is the global reach, the ability to reach out to chapters in Delhi or London or Singapore when you're interested. In fact, we've got one company that had a nice product that we didn't, when he approached us for help, it just didn't seem to be a real good fit domestically, but we thought it was a great product for developing countries, and we're able to reach out within TIE and find those contacts for them. So I think we're proud of that global reach. I think it's a great value to people who want to expand globally and wonder, well, how do I get contacts to India? How do I get contacts to other countries? Well, you can come to TIE and we can help you with that. You know, in addition, you know, so our monthly event here is, you know, one way in which we implement this giving back and the networking and the education. We also do it in some other ways. Another program we have is TIE Young Entrepreneurs, which is a business plan competition for high school students. That's concluding next weekend with the presentation of the plans, the actual competition, and the judging of those business plans. Grand prize there is $5,000. The second prize $2,500, and the third prize is $1,000. About 7 teams competing, around 28 students. So that is a wonderful program if you have high school students to get them involved in. It's where I think they really begin to apply. Well, I remember sitting in some of the classes and thinking, you know, why do I need to know that? And this is where they actually get to apply it and find out why you need to know many of those concepts. And where they put it all together in a business plan, they get really excited about it. It's fun to see them grow through the course of the program, which runs from October until April. And to watch them grow, actually watch them get nervous and stand up in front of the judges and present their plan. But it is a wonderful way where they connect the dots. But with the academic knowledge and the practical application, the why behind their learning, you know, why they're learning the things that they're learning, and so that is a great program, great resume builder as well for them. But it's just a program we're really proud of and wonderful. So if you have high school students, please you know, go to our website. And you just Google it, you know, TIE San Diego. You'll see events. Look for TIE on there, and you can reach out to us, and we'll help you get your student involved. We also have a mentorship program. We have the TIE Institute, which we have some other kind of nuts and bolts programs. We'll go into the detail, but I encourage you to go to our website and learn more about those. Let me. I mentioned our charter members. The charter members, individuals, really, you know, form TIE and work behind the scenes to manage the organization. We have a few of those here tonight. I think BK, are you here? There we go. Hi, BK. So if you wouldn't just raise your hand there. So BK is one of our charter members. Saran, who I introduced earlier, and also Nikhil Varaya, professor at San Diego State, he's here as well, will moderate the panel. So they work behind the scenes as well as our executive committee. I know Mark Leibowitz is here tonight, member of our executive committee. And I didn't get executive committee count. But then we have the executive committee, which also helps to put these events together. Of course, none of this would happen without Priti Pruitt, who I think has just walked out the back door there. Oh, there we go. Hey, Priti, who runs behind the scenes. So if you called and inquired, she's the one who's picked up that phone and answered the questions you might have and brought you here to the event. Another one of our charter members, Neil, who was the president of the group before me for about 2 years, has just walked in here, Neil Kripalani. Neil, here we go. Thanks. Good to see you, Neil. So with all that said, let me also talk about the people who kind of helped fund the group. Hayden Trubit is here from Stradley, Yoka, Carlson, and Roth. Here we go. Hayden, you wouldn't mind just, there we go. Thank you for your support, Hayden. Appreciate that. One of our sponsors to the organization. Thank you. And again, before I introduce the panelists tonight and the moderator, actually Mark Leibowitz, who will introduce them, let me talk about the next events. So April 24th, we have an event, or about the event, the Entrepreneurial Opportunities in Green Technology. And here we'll have a panel. One of the panels will be Mike Hurst, who's the CEO of Chlorophyll. Nigel Bealey, the CEO of, should practice that one, Mark? Energy. There we go. Thank you very much. We also have a representative from Eco Reeboks, and then also Chuck Copen, CEO of Renew-It, who has a mobile phone, a solar-based charging system for cell phones. That'll be moderated by Holly Garrett, CEO of Clean Energy Principles and co-founder of Eco Topics. May 22nd, the event will be Incubators and Resources to Support Entrepreneurial Company Formation and Development. And here, the panelists will be Kevin Hell, who's chairman of Evo Nexus, Rosabelle Ochoa, executive director of the Von Liebig Center for Entrepreneurialism and Technology Advancement, and Rupert Von Butler is the director of Business Creation Development with Connect. And that'll be moderated by Greg Horowitz, who's the director and co-founder of Global Connect. So those are the next two events. Look for those email blasts, and please RSVP, and look forward to seeing you all, especially those new members, our new attendees at those events. So with all that said, let me introduce Executive Committee member Mark Leibowitz, who will introduce the panel and the moderator.
Thanks, Patrick, and I'm really glad to see everybody here tonight. When we started talking about this event, we recognized that the average starting entrepreneur focuses on getting their company going and all of those challenges. And they don't really think about or recognize the impact that the potential exit from their company has on how they might structure it legally, how much money they need, what kind of money they might want to take. So that's how this panel and this event was generated. So tonight, if the panel could please come up, I will very briefly introduce the panelists and then the moderator, and actually I'll leave it to the panelists to really tell you about their histories. But I want to tell you who they are. Clearly there are legal ramifications involved in forming a company and in thinking about exits. So Jeremy Glaser is with us. Jeremy is a partner at Mintz Levin in the Corporate and Securities Section here in San Diego. He also is co-chair of the Mintz Levin Venture Capital and Emerging Companies practice. Jeremy has worked with a lot of companies in town in a lot of different areas. So you also have to have people, entrepreneurs, ideas. Randy Woods is here. Randy is a serial life science entrepreneur and pharmaceutical and biotechnology executive. He, as you may have seen if you looked at his bio, he has over 39 years of experience in this arena. He was previously the president and CEO of Novocardia before it was acquired by Merck. And prior to that, he had been the CEO at Corvus, another publicly traded biotech company. So once you get companies going, you have to take them somewhere. And one of the potential places they can go is to be acquired. So Jeff Securities is here this evening, and Jeff is currently the Vice President and the Head of Mergers and Acquisitions at Life Technologies. That's a role that he has had for numerous years. He had before the acquisition or the merger of Invitrogen and Applied Biosystems in 2008. And finally, if you're going to have companies, you have to fund them. And David Titus is here this evening. David is the president of the San Diego Venture Group. He also is managing director of Windward Ventures. So I hope that you'll find this panel stimulating and enjoyable. I'd like to ask all the panelists to please turn on their microphones. There's either a button on the bottom or on the side. And with that, I'd like to introduce Nikhil Varaya. Nikhil is going to moderate the event this evening. He is the Director of Graduate Programs and a professor in the Department of Finance at SDSU. And in addition to overseeing a series of graduate programs and teaching, his research interests are in the areas of mergers, acquisitions, valuation, and strategic management. So he has a very unique and appropriate perspective to lead the discussion this evening.
Is this like homework? You folks have a one-page handout in front of you. What I've done is try to put together some data to motivate what the panel is going to talk about. And so very quickly, if you look at the data, what I've tried to do is provide some sense about what we mean by exits. So the very first sort of slide that you see says evolution of firms from startups to public corporations. So what that is if you were to follow sort of 1,000 startups for about 15 to 20 years, what would happen to these companies over time? And so what you tend to observe is that within about 5 years, about 65% of these companies will vanish. That's the green lines. And there's probably about 25% of the companies that will remain private, and some of them will do very well. And then there's a set of companies, about 50 to 100, say about 5 to 10%. These are the ones that we all have a lot of interest in. These are the so-called rapidly growing companies. And these are the ones that attract the attention of people like David and other angels. And what tends to happen is that one of the things about these companies that's very attractive to all of us is that some of them may go public. So what you find is that from that group, maybe about 10 to 30 or 1 to 3% of the companies are going to have IPOs. What also tends to happen is that after IPOs, some of these companies don't do very well. That's the set of companies that I've shown them going down, so a few of them will in fact fail even after IPO. And then there are a few companies that after IPO, they remain essentially flat. So on that vertical bar, what you see is the value of the company, is that there are companies that there's a lot of promise at the time of IPO, but things have changed and they essentially become sort of small cap companies. And then you have the companies that become your Qualcomms, your Procter & Gamble's, and so on. Those are the so-called long-lived public companies. Those are the companies that you see in the purple line. And that group is about 1 to 2% of all companies. So exits are tough, and I think the panel is going to talk about exits. And one other thing that I want you to focus on is at the back page is some data that if you look at just the top panel, this is from a recent study that is coming, that came out of Duke University that looks at the common exits of companies which are IPOs and acquisitions. And what you tend to see is, for example, that if I look at these companies that were VC funded and non-VC funded, you can see there are stark differences. That VC funded companies tend to have exits more frequently than the non-VC funded companies, and acquisitions also. And what you tend to observe is the numbers are still rather small. So for example, roughly 5 years after they were observed, that percent of these companies that are acquired are about 18%, and those that have IPOs are about 5%. So these are small magnitudes of numbers. So this sort of gives you a sense of what these exits are about. And so the panel that we have today is a stellar panel in terms of their experience with types of exits. And the market is changing quite rapidly. And so we want to get their perspectives. And so I think the way I'm going to start off today is start with, from here, David, and each of these folks, I'm going to ask them to spend a few minutes talking about, in practical terms, what do they think about exits, what are the types of exits, and exit strategy options. So I'll start with David, and we'll follow with Jeff, and go from there. Thank you.
Oh, wow, free speech. Let's see. First off, thank you. This is a beautiful venue here tonight. It's just great. I'm going to have an event here. I don't know what it is, but it's a beautiful venue. I'd like to thank Ty. Ty, those of you who don't know, Ty, a month ago, Patrick, 2 months ago, had a premiere of a movie here. One night, Something Ventured. Shameless plug, April 19th. You can see it at Qualcomm Auditorium with the Venture Group. Okay, shameless plug over. So, entrepreneurs out there, which line do you want to be on this top chart? Which one? Here. That one on the top? Oh, hell no. Oh, hell no. That's a terrible life. 98% of you don't make it. Those of you who do are subject to public scrutiny. Your neighbors and friends all know how much money you make. Okay? You want to be on this line here, that lower red line where you're private and making a bunch of money. You take home millions of dollars a year, no one cares. You don't have to answer to stockholders. It's really a great life. Wouldn't you agree, Jeremy?
Yeah, I usually tell them that when companies are about to go public, I tell them to look at me and make sure that they like me as their lawyer or lawyers in general, because they're going to spend a lot of time with us. So I agree with you. Why would you want to do that?
You wouldn't. Okay, psychopaths run public companies. No, think about it. Larry Ellison? What, huh? You know, I mean, come on. Zuckerberg? Well, we don't know about Zuckerberg yet. So, and what's an interesting thing here is if you look at this on the venture-backed side, you'll see that at the end of 10 years, when my partnership's supposed to be done, 37% of those companies are still private. If you're a venture capitalist, you know what that's called? Hell. You can't get rid of them. You can't shut them down because they're making $2 a year. So, what the heck am I supposed to talk about here?
Still RVC.
Okay, yeah. So M&A, or selling your company or getting out. You know, the devil's bargain. Venture capital is the devil's bargain. Once you take venture capital, you have agreed that the objective is a liquidity event. It's not to employ your kids. It's not to own the company for 30 years. It is, in fact, to find a liquidity event. So it's natural for a prospective investor in that case to want to talk about what you're thinking and what the market's thinking. We have a great company in our Windward Ventures portfolio. It's been profitable for 3 years. It employs 25 people. We cannot sell it to save our soul. Why? Because it's doing $3.2 million a year in revenue, and there are only 3 potential buyers, and $3.2 million in revenue doesn't matter to them. So I think from a venture standpoint, exit is a primary objective. For a lot of other companies, exit may not be a primary objective. So you really have to ask yourself, what are your objectives? If you're, I was talking to Rob Benson from ID Analytics. I'll pick on Rob here for a moment. ID Analytics just sold to LifeLock. Great transaction, okay? Seller's dream. They've come in, they haven't changed anything. Didn't fire anybody, didn't cut the budgets, didn't do anything. But you know what? That CEO now has a boss. First time he's had a boss in how long, Rob?
At least a dozen years.
Okay. Just take a little break here. You guys can hear me, can't you? There we go. So, so now you have someone with a boss. If you don't want a boss, don't sell your company. You know, if you don't want shareholders, don't take it public. So there is some value to thinking about this ahead of time. I'm going to turn over the microphone to someone else because.
I'll just point out one thing, and that is that M&A is not on that chart.
That's why I've got the chart at the back. Yeah. So private could be an M&A firm.
So, thank you, David, and thank you for having me. I'm Jeff Sakaris. I work at Life Technologies in Carlsbad. We are primarily a tools company selling to research laboratory scientists, but we're a relatively large public company, roughly $10 billion in market cap, roughly $4 billion in revenue. And across 20 or so different business units, we're in a lot of different market segments, and so we do a lot of evaluation of small companies and tuck-in acquisitions. I've been in the role for 6.5 years and have a bit of a science background.
Time out. How many of you out there know what a tuck-in acquisition is? Okay, explain.
A tuck-in acquisition, it's first of all, it's a very loose term. If you're a $100 million business, a tuck-in acquisition might be 10 or 20 million. For a company of our size of $3 billion in revenue, $4 billion in revenue, a tuck-in acquisition could be 200 million to $1 billion. So, it's a function of scale. I think this died. Hello? So, to talk a little bit about exits from our perspective, so practically speaking, it's quite obvious. The exits that come into us are primarily M&A. Panelists here will speak to you about IPOs. You can also shut down companies, and a lot of that happens. But the way we like to think about it, especially when we approach a company, is it's not about the deal structure in which they come into the organization. It's about the sellers who've created a piece of IP, a business, whatever it might be. It's about how you're going to extract value out of the company. And you've got some panelists here who do a lot of different deal structures that extricate value from a company. From our perspective, my team primarily does M&A, but oftentimes when we're courting a company, we may realize that it's not the right time for them to be acquired. So we sometimes might do an equity investment, and so we might take some of the value off the table at that point in time, and we might buy it later, or we may just participate with VCs as they eventually liquidate. But there are also circumstances in our industry, as well as in pharma, which Randall will talk to you about, where sometimes we're just looking to get a patent, a technology, a platform, or distribution rights. So you have to be thinking about what are you creating, and instead of selling your company or IPOing it or doing whatever, could you piecemeal it? Could you separate it up? Could you divide it into different fields of uses? Could you give it to multiple parties through out-licensing or through distribution arrangements? And a lot of times you can potentially extricate more value for your company through that mechanism than you might doing it from one specific M&A transaction. So from our perspective, when we approach companies, we're very agnostic towards deal structure. It could be acquisition. An in-licensing group at our company might help us do an in-license. We might do more of a distribution arrangement. We might do an equity investment. But a lot of how we approach the deal structure is about matching the objectives of us versus the objectives of the seller and their best way to create value out of what they've created as a company.
So my name's Randall Woods. I spent the first 20 years of my career in big pharma. These last 20 years have been more on the biotech side, primarily venture-backed, but I did run a publicly traded biotech for about 8 years and ended up selling that. And so these last 20 years, it's really been quite a quite a change in what I've seen. We were talking about this a little bit earlier that, 10 years ago, we were maybe even less than that. We always talked about how do you get money and try to create a company, create value in that company. You really didn't think as much about exits. Now, I'm right now in the process of starting a new company, and I'm talking with a number of venture firms, and they're very specific in their questions, and it's how much money is it going to take, and what are the activities that we're going to be funding that get you to the point where somebody's going to want to buy you, or it gets you to the point where we know this drug isn't going to work and we want out. We don't want to continue to put any more money in it. So it's really very different than it was 10 years ago when you really didn't think about what the exits were. It was how do we build this company, how do we build value. The other thing that I don't know what David's, I don't think this is on. I don't know what David has seen, but some of the venture groups that have funded us, what they are actually doing.
Can you all hear in the back?
Okay, yeah, because I have sort of a loud voice. So, what some of the venture groups that I have a good relationship with, what they're actually doing now is they're going to some of the large pharmaceutical companies and they're saying, what are the kinds of projects, companies, what is it you're looking for to buy? And then what they do is they actually go out and try to find the assets and the management team around those assets so that they feel like they're going to have a built-in exit if they can successfully navigate the clinical trials or whatever point they need to be at in order to get a company to something. So they're actually going and asking them what they need to create in order to have a built-in exit. You're right, the IPO market, they just totally discount that. They don't count on that at all. They really want you as the CEO of the company to convince them that there is an exit and it's most likely going to be an M&A. The last company I sold was a company called Novocardia. I sold it in 2007, which is sort of right before the financial meltdown.
Good timing, right?
Yeah, it was very good timing. I've always been a lucky guy, It helps to have some luck. And, I think we got about $375 million all up front in that transaction. And, again, you just don't see that now. The transactions are very structured. They might agree to a certain amount of money, but it's going to definitely be tranched, and tied to different milestones and the success of reaching those milestones. And it's just, it's probably the most difficult time I can ever remember in the almost 40 years that I've been doing this. Jeremy.
So yes, I'm a lawyer, and I've been practicing law, doing M&A, IPOs, venture capital financing for, over 25 years. But I also bring a sort of a different perspective as well, in that I was an in-house counsel at a hedge fund that invested in private equity. And I was also a member of the senior management team of an internet company during that very exciting time, during the internet .com bubble. I was with a company where I was the head of mergers and acquisitions and strategic alliances. So I actually got to do the kinds of things we're talking about right now as principal.
How'd that work out, Jeremy?
Oh yeah, well, I think we all know about what happened to some of these .comers, right? I'll tell that story as we go on, but the fact that I'm still practicing as a lawyer tells you how well it worked out. How's that? So, Dave, I think, touched on this a little bit. What I want to just quickly point out, and I think you've heard this in some of the conversation from the other panels, is there's lots of different types of exits. When we think exit, I think a lot of times, especially in the tech space, entrepreneurs think IPO, right? Because that's the big, sexy thing, right? You get to go out, you're a big splash, you're selling to Wall Street, you get to have the big party when the stock runs up, right, and breaking out the champagne. And I think we all got sort of in that mode, especially in the late 90s and into the early 2000s. After the .com crash, after some of the changes in the law, Sarbanes-Oxley, the rules that came out of sort of the separation of analyst coverage from some of the smaller IPOs or investment banking houses, we saw a real fall off of the IPO market. And what happened was we started to see an increase in a relative percentage of M&A. What's interesting about these statistics is I noticed that they're sort of all-inclusive 81 to 05. I would love to see these statistics sort of 81 to 2000 or 2001, and then 2001 forward. My guess would be we're seeing a much more significant increase in M&A as a percentage and a very significant decrease in IPOs. If you actually go onto the NVCA website, they have some really good statistics on that, and you can see the real fall off in IPO activity in technology companies and the much larger increase in M&A. And certainly my practice reflects that. And especially here in San Diego, when you look, I mean, just the vast majority of companies are exiting now through M&A transactions. However, there's other types of exits too. You don't have to have the big transaction, the IPO or the M&A. We talked about, you heard about licensing transactions, right? In licensing. A lot of companies, their exit is that they get a nice licensing deal. And they end up getting a very nice cash flow that allows them hopefully to maybe do some new products, maybe to finance that great big new house in La Jolla or that big fancy boat. But that's another way to get an exit. So you don't have to have the great big sale in order to get to liquidity. And then the last exit that we see, although a little less here in San Diego than in places like the Bay Area and Los Angeles, where there's sort of larger, more established companies. And it's sort of like an M&A, but it's a special kind of M&A, is the management buyout or the leverage buyout. And that's another way of getting you out of your investment. Again, typically with companies, much more significant cash flow. And then there's the final one that I always like to sort of point out to people. You can just make money, right? You can just have a business that's successful and that grows revenue, and you can pay yourself a really nice, salary and distribute the profits, right? So there's lots of ways to get to an exit. And we'll talk about that. I think later we'll talk about planning for an exit and how you sort of plan for all these different options.
Okay, what I'm going to do is have one more round of questions and then open it up. So I'll start with, again, you, Jeremy. What are the factors to be considered in exit strategy? The choice of investment banker, tax considerations, startup's ownership or capital structure?
Sure. So, way to start that out, I want to sort of just quickly point out that, from the moment you form your company, you need to be thinking exit. And when I sit down with entrepreneurs and we're talking about even something as basic as, are you going to be an LLC or do you want to be a corporation? We're talking exit. We're talking, do you think you're going to sell this company? Do you think it's going to go public? Do you think you're going to just get cash flows from operations? And all of that drives the decision. So you need to really be thinking about, are you going to have an exit? What kind of an exit? Even as early as starting up the company. So, I think you need to be thinking about the capital structure, how you're going to raise the money. Are you going to bring in a venture capital firm, for example? Dave, I think, did a wonderful job talking about how VCs will drive you to the M&A exit. That may not be where you want to go, and so you need to be really taking that into account in every step, like literally every decision, formation, the type of way, the way you're going to raise money, whether it's debt capital, whether it's preferred investment from the VCs. All these different steps matter. So the reason I mention that is I don't want people just to be focusing on, well, gee, I'm now about to make, I'm making a decision about an exit. What do I do? There's a lot of decisions way before that you have to make before you even get to that point. Now look, once you're at the point where you say, hey, I've got a successful business, or I've had a buyer approach me, then there's a whole other series of decisions. One that was mentioned was, for example, an investment bank. And I can't tell you how often I have people come to me and say, hey, I've got a buyer, I've got a term sheet, why do I need an investment bank? They're going to charge me some fees, right? They're going to take some of the money off the table. Gee, maybe they're going to get in the way. Why do I really need them? And I got to tell you, my advice to people all the time in that situation is, you want the investment banker. And even if you have the buyer, and even if you're not going to be going to look for new buyers, there's a real advantage to having an agent involved in the negotiation process, especially for a founder. We talked about having a new boss, right? It's not very comfortable to be negotiating with your new boss on really tough issues like price and compensation and earnouts and indemnities and all the things that come up in an M&A negotiation. When you're thinking about, I gotta work with this person, he's gonna be making decisions about my bonuses, my advances, you really wanna have that third party who can play that sort of bad guy role. And while lawyers can help in that way, and we're really good at being bad guys sometimes, right? So I see a bunch of lawyers I know here in town. The investment bankers really do play a different role. So I
Because
do
they're even
urge
badder
people-
than the lawyers.
They're better at negotiating price, and I'll be more positive. So I really do urge people to really think about that, and actually, I really recommend to my clients that they do engage a banker for that purpose. Let's see, you talked about tax considerations. And then I'll let others jump in. So tax considerations, again, I mentioned quickly, whether when you're forming the company, corporation versus an LLC. So even as early as the formation, the tax implications of how you're going to exit matter dramatically. I don't want to get into all the details, but I think everybody knows an LLC is basically a pass-through entity, right? So if you're putting a business together that you think is going to end up being a licensing ultimate exit or bringing to profitability and distributing out the cash, you probably want to be thinking about an LLC because you're going to get that cash out to your investors without having to pay a corporate level tax on those profits. So you make that decision early. If you're thinking you're going to be doing ultimately an M&A or an IPO, well, you're really going to be keeping those profits within the company and growing the value of the business for that ultimate exit. So you might be thinking a corporation. And as we all know, for a long time, especially with tech companies, you don't earn a lot of money at the corporation. So it's not like you're paying tax, at least not too much at the corporate level. So the tax considerations matter at formation, and then they absolutely matter at the time of the exit. And again, we could do a whole seminar with a tax lawyer up here about different structures and different ways you try to, whether a sale is a tax-free transaction, whether you have a taxable transaction, and the different ways you can do it. But bottom line is, and this I will say because it's very important, is anybody out here, you'll have no excuse for doing this because you heard this at this panel. If you ever get a term sheet or a letter of intent from a buyer, please, please, please do not negotiate it yourself. And do not sign it without talking to a lawyer or an accountant at the minimum. And I'll tell you a story later when we get this about a deal that died because someone did this, all because of tax issues that they didn't think through.
Thank you. Randall, you've been in this business a long time. You've seen some good times. The last few years have been tough. How should you as an entrepreneur think about exit in a tough economic environment?
It's tough, all right, these days. I've never, it's never taken me as long and it's never been as hard for me to raise money as it has been more recently. But before I actually launch into that, I'd like to underscore something that Jeremy said, and that is, it's interesting, I think I told you, I'm right now in the process of creating this new company. It's basically we're taking an asset out of a large pharma company that was just going to put it on the shelf, and we're going to create a new company about it. And I think before, whenever we create companies, we probably made them into C Corps, right, that the venture groups would invest in. And the thing I'm finding is that it's a free-for-all out there these days. I mean, it's kind of like all the old rules and all the old boundaries that you knew about before. They're just like out the window, and it's really a little unnerving. And like I said, I've been doing this for a long time. That it just seems like a free-for-all. And so to Jeremy's point, it was actually suggested to us by our attorneys that we really ought to think about an LLC and think about what that exit is. And we never would have, or I've never done that before, and I've been involved with starting a few different companies. So it is really true, what Jeremy's saying. I think because these venture funds, because that's what I do now is try to get venture money to start these companies. I think because they're having such a difficult time raising funds themselves, what we're finding now is a lot of these funds, venture groups, are at the end of their funds. They don't have a lot of money left to invest. And so there are a lot fewer of these folks that are out there. And so the ones that are left are just getting, so many business plans or opportunities to fund. And so what I think is difficult now, even more so than it's ever been before, is that you have so much competition, so many companies chasing fewer dollars. And so the venture funds are being really selective. And once again, they want to know exactly you know, how much money it's going to take, and what activities am I going to be funding, and where's that going to get me, such that we can hopefully get an exit, and then what's the backup plan, and what's that going to cost me. It's just, you know, I don't want to, I sound sort of discouraged. I don't want to be discouraging. Actually, I actually sort of thrive on this because I want to win, just because it's taken me longer and it's harder. I feel pretty good about the fact that I'm actually going to get this company funded here probably in the next couple of weeks. But it's just the diligence. I mean, there was a time when they just sort of threw money at you, and now the level of detail that they're looking at, it's just like, you know, weighs you down. So I think for those of you who will give it a lot of thought and really put a lot of thought into where's the soonest opportunity, how can you create the most amount of value or get it to a point, the soonest point that you could maybe find a buyer for it, that's what I think these folks want to hear is, you know, be creative and think about where's that first opportunity and how's the fastest way to get there and the least expensive way to get there. And I don't always think that's the best way to approach things, but that's what you hear over and over from these guys. So I don't mean that as a bad rap in the industry. No, I actually, you know, the other thing that's really important if you're out there and you happen to be, you know, trying to raise money for a company and you're talking to venture folks, the other thing that is critically important, and I can't emphasize it enough, is really try to stay, and this isn't always easy, but you want to try to get sort of the top tier venture groups, because I've found it really makes a huge difference in terms of how you can run your company by what venture groups you associate yourself with. I've been extraordinarily fortunate that I've always had a company, for example, called Domain Ventures here in town, Domain Associates. They're amazing, you know, and they're with you in the tough times, and it's almost like family, you know, they don't let you fail. They're there and they support you, and obviously they're there in the good times, and it probably helps that, you know, I've made them a lot of money too in the past, but that seems to help. But it's kind of like, don't tell me what you did for me yesterday, you know, tell me what you're doing for me today. But I also think it's really important in terms of what venture groups you associate yourself with if you're looking for a company that you then eventually want to try to get an exit from.
Okay, now we'd like to get a perspective from Jeff. Jeff, what process does Life Technology use in making investments, and how does a seller's exit option feature into that?
Let me give it a little bit of context here. I thought there was something interesting in this graph. When you get to a company of our size, and we're about $10 billion in market cap, you're kind of on this red curve, and you're kind of hoping to stay there. And a lot of what my organization is doing is trying to take a $10 billion company and make it a $20 billion company, and having sustainability so that people are still talking about this company in 40 years' time. And as a result of that, what we end up doing is, if we've got $4 billion in revenue across 20 or so different business units, we're screening for the next best startup or the next best technology or the next wave of revenue growth for the company across any number of those market segments. And so, as a result of being a big company and having to screen a lot of things, probably similar to what Domain has internally, we've got kind of a whole squad of people. There's 5 people just on the M&A team alone. There's about 15 people doing in-licensing. There's about 30 people doing out-licensing. But we've got whole units dedicated to these functions. And my specific unit has its own rigorous process for look at the market, okay, figure out what 4 people are in that market, and then go after 1 or 2 of them. And it's the types of things that we're looking for in these companies are, you know, competitive advantages, management teams, once they come into the company, can they grow, can they excel? But we very quickly make decisions on whether this company is viable or not. And oftentimes, sellers are very, they're very high on themselves. They've got something unique, it's their baby. And from our perspective, we get it, we understand it, and there may be no alternative to buying their company, but when you're trying to grow our business as big as we are, we just might focus on the other 19 market segments that we're in. And so, if we're running into problems dealing with a seller in one specific area, we'll then just deploy kind of our whole team and our process towards other segment areas. But, because we're dealing with such a high volume of deals, we end up going through a very stage gate process. It's almost like a product development plan where you take a company to a level of feasibility, you run through the executives, why you're looking at the company, what are the financial returns, what do you have to pay, when do you think you can close it. You then perform due diligence, and to Randall's point, we just overwhelm companies with due diligence questions. We are more rigorous today than we were 5 years ago, I think, whether it's a scarce capital that's out there or just, in general, people are seeking higher returns. Diligence has gotten worse and worse and more rigorous than it ever has been, and we do the same. So after a period of, say, 6 to 8 weeks, legal diligence, commercial diligence, IT diligence, you name it, we'll then do another kind of stage gate review with an executive group and look at similar things. What has changed? Have you found anything? Tell me what the returns are again. Should you go forward? And then, if we move forward, then we do the transaction. And, one of the differentiating things that a big strategic company has, and if they do this a lot, they eventually develop over time a whole practice, a whole team that's dedicated to integrating companies. If you ever read journals about when M&A fails and when it doesn't, it's not that often in, you didn't find something in diligence or you paid $10 or $20 million more. It's more about, once you bought it, did you take your eye off the ball? Did the deal team go on and work on something else? And did you not have an appropriate executive? Did you not have an appropriate set of functional stakeholders that were going to take this baby and integrate it into the machine, integrate it into the sales force, just get it into the IT systems, just even launching a SKU in a big Oracle system like we have is a labor, and it's actually a skill set, and if you don't have people that have done it before, you might be 6 to 9 months delayed from really extracting the synergies of putting a product into our channel. So, that's kind of the process we go through, and I really emphasize that it's across many market segments, and then you really got to finish it through once you do close the deal. It's not over until you've really run that company for 5 to 10 years and you actually get your money back, because M&A for a company like ours, you don't get your money back in 3 to 5 years, if that's what VCs can even get nowadays. We buy these companies, and the types of premiums we pay, you're not getting your money back in a year. You really got to execute this for the long term. We're talking anywhere from 3 to 7 years to really make your money back. So,
last but not least, David has been in this business for a long time. So David, 2012 compared to previous 6, 7 years, what have you seen and where is it headed?
Can I answer a different question?
No.
No, because the question I really wanted to answer was when. When do you do this? Can I answer that question?
Sure.
Okay.
But tell us also how things have changed.
Things have changed. Okay, so I'll work that in. So when do you do this? When do you go public? Well, you go public when you have to. Why is Facebook going public? Answers?
500 shareholders.
They've crossed the 500.
Okay, Hayden wins. The lawyer in the audience wins. Tell the people why.
Because they had a number of total shareholders which exceeded a threshold set in the Securities Exchange Act, they were required to become a public reporting company one way or another by the 120th day of 2012. So if you got to have the bitter medicine, you might as well get the sweet along with it.
Right. So they don't need to go public for the VCs. They're selling shares on second market. They can distribute out. You think Zuckerberg wants to go public? He did not show up to the analyst meeting because he had more important things to do. So you go public when you have to. In Groupon's case, they needed cash. Okay? When those things meet when you can. Groupon went public because it needed cash, but it also could because there was a market for Groupon at that point in time. You go back to 2000, why did Pets.com go public? Oh, hell, because they could. They could sell 5% of the company for $150 million. It was a hell of a deal. That market doesn't exist anymore. The company that can go public without great fundamentals is rare. Groupon is a rare one. It remains to be seen whether they have great fundamentals. On a sales side, I don't know that the world's changed dramatically in the last 5 or 6 years. Depending upon what segment you are, there might be fewer buyers. Due diligence is probably more rigorous there. But when do you sell your company? And, you know, historically, I kind of look at things. Sometimes you sell because you can't take the company any further, you and your team. You've taken it as far as you can. We had a company, they did a great job. It was a 3-person management team. It was clear that to take the company to the next level, we'd have to bring in a new team. That would cost us in the form of equity. We'd need to give the new folks. We liked the current folks, and so we sold the company. So I think you have to ask yourself, is this something I can continue to run for the next 2, 3, 5, 10 years? You know, and if you have a modestly growing company, that's easier than a company that's doing this. It's hard to do this. The number of people who can manage this from here to there is real tough. You know, you sell your company sometimes when you're not ready. You may think that the right time to sell your company is 2 years from now because you're going to do this or you're going to do that. But you know what? The market tells you it is now. The buyers say, look it, it's happening now. We're going to buy someone. We're going to buy him, or we're going to buy her, or we're going to buy him. And right now, we like him. But if you don't want to do it, we're going to go buy her. So sometimes the market tells you when it is time to sell. And if you're in a consolidating market in particular, if there are 4 or 5 big guys who control what's going on, if everyone needs a certain type of diagnostic test in their portfolio, Jeff's going to have it on his shopping list. And we need a wolf rabies diagnostic kit. You need one of those, right?
Yeah, I'm still looking at that.
Okay, if you have one. Okay. But you know what? He's going to buy one that year. And you may want to wait a year or two before you sell your wolf rabies diagnostic kit, but you're going to miss the boat because he's not going to be in the market the next year.
So Dave, I have to interrupt you for a second. This reminds me of, like, there's very few M&A jokes, but it reminds me of one of the great M&A jokes. When is the right time to sell your company?
I don't know, Jeremy. When is the right time to sell your company?
Anytime.
When you have a buyer.
Well, that's not always true. Thank you.
Good joke.
Okay, so here we are. My partner's old fund. It's a $25 million venture fund. He's paid out $50 million. This was the good old days. $50 million already. We got one company left. That company has $6 million of paid-in capital. We're 14 years in the fund, right? We're off this chart here. We're way out here. And we have a buyer for the company because we need to get rid of it. $6 million buyer. We're a week away from closing. And the buyer says, you know, we think 4.5 is a better number. So we go to management. We said, what do you guys want to do? We don't care. We get 100 cents on the dollar, 80 cents on the dollar. We got 2.5 million in this company. So whether we get 2.5 or 2.2, it really doesn't matter. We've paid out 50 million. Management says, screw them. We got a buyer, but we don't like him. And because this company was profitable, which is a really important concept, and didn't need more capital, which is where Randy gets in trouble, because if you're doing drug development, you always need more capital. We said, forget it. And so this company went along, and we made a little money, and we lost a little money, made a little money, lost a little money. 5 years later, a bunch of guys fly planes into the World Trade Center. Our business goes like this. 5 years later, that company where we turned down $4.5 million, we sold it for $90 million. We took out, the fund took out $25 million. The management team took out $15 million. So it's not always when you have a buyer. But if you don't need the cash, you have a lot more flexibility. So I think that's really a key. And then my final point is, why are the Padres getting sold in the next 2 years? Answer?
Estate plan.
Not quite close. You're close. Why?
Divorce.
No, that's already happened. He's paid her off. Okay? That's what the first 49% went to. No. Capital gains rates go up by 6 points in 2 years. I don't care about capital gains. My investors, and this is true of most venture capitalists, we're very tax insensitive because our investors are tax exempt entities. They're pension funds, they're endowments, they're foundations. They don't pay taxes. Okay? But the Padres are owned by an individual. And so if you're an individual owner, tax considerations, I think, play a much bigger role than if you are institutionally owned.
Well, and in fact, the tax rates are going to go up January 1, 2013. It's just a question of how much. There's going to be the increased rate on anyone earning over $200,000 because of the health care tax. And if we don't extend the Bush tax cuts, that 15% rate goes to 20%, or potentially even higher if they don't put in a favorable capital gains rate. So it's right around the corner. It's actually next year.
I'd like to open it up to questions from the audience. Go ahead.
How do you think the Jobs Act is going to impact IPOs? Has anybody gone through it?
I think this is, wonderful news. And so, as an attorney who really made my living from 1985 until 2001, doing sub $100 million IPOs, the reality is, whether people want to, we can have a debate about it here if we want to, but the facts to me speak for themselves. When Sarbanes-Oxley got put in place, and the cost of being a public company, not the cost of going public, the cost of being a public company went up dramatically, literally by a factor of 4. It killed the small IPO market. So the ability for us to have these sub $1 billion companies for 5 years without having to have the Sarbanes-Oxley requirements, the internal control requirements, I really believe that this is going to open back up again a smaller IPO, which is really important for a place like San Diego, Southern California in general. That's where these IPOs tended to occur. And then we can get into more the issues around analyst coverage also that the Job Act fixes is also very, very favorable. So on the IPO side, I'm absolutely delighted when the NVCA came out with some proposals about this and a committee of Treasury. I thought it was wonderful, and I'm just delighted they got passed. The crowdfunding stuff, we can have a whole separate conversation about because I think that's dangerous, and we've been down that road.
It's going to be so fun.
We've been down that road before. Sometimes having gray hair and not much of it means you've been around a while, and we sort of did this before when we put 504 in Reg D, and it turned out to be a real mistake, and we ended up re-regulating it, and states had to jump in and deal with all the fraud. So the crowdfunding, I have a different view on.
David, do you have anything to add to?
I think the jobs bill will be good. I think, like most things, there's no panacea, Ken. You know that. You've been around long enough. But I think it's the right direction. I think it's one small sign that Washington, we got through to them a little bit there. But it's a flip side. It also let Facebook stay private for another 2 years, which is not necessarily a bad thing, but that was part of the Jobs Act too. You can have more shareholders as a private corporation than you could in the past. So I think it's generally positive, but it's mostly incremental. The crowdfunding's going to be wild to watch and participate in, but we'll see how that shakes out.
Yeah, gentlemen, if there were any Chinese or Japanese nationals in the audience listening, they'd giggle at this whole panel discussion because they have a longer sense of history. But giving this an American spin, my mother's great uncle gave a check for $25,000 to Thomas Edison in 1922, 1924 to start Western Electric, which became General Electric. And nobody in the family ever had to work after that. So my question is to you, can you also balance this discussion by talking about the words legacy and long-term value creation with the phrases?
Legacy and long-term value creation.
And actually on this chart, there's no line for high-growth private companies. So
Sure there is.
Oh, there is.
It's a red line
The
right
red
here.
line
That's
is-
why I was saying that's where you want to
The
be.
slope rate for the private companies is lower than the public companies. Why is that? There are high-growth private companies. Where are those? Where's S.C. Johnson and Target? Where are they?
But you know what? They're large companies.
No,
They're
they weren't 20 years ago or 50 years ago. Or
50 years ago. You know what 10% a year over 50 years does? It's a really big number.
That's infinity, yeah.
Okay? So I think, you know, we get these irrational senses of time. People go, oh my gosh, it's going to take 8 years to build a public company. 8 years is nothing. How old's life?
Founded in 1987 in a garage in San Diego.
Okay? So, you know, it takes time to build a substantial company. It is once every decade you get someone who builds rapidly a large, sustainable company, an Apple, a Facebook. You can't do it in about. Has anyone done it? I mean, Genentech took 15 years to get big.
Last
Yeah,
30 years.
you know, so it's rare that you build that. So I mean, my personal view is that to build substantial, lasting companies is a rare feat that takes unique people, unique circumstances, and a long amount of time.
And I think the world has changed a little bit too. I mean, in this way, there's a lot more activity in sort of M&A markets, right? There's a whole industry, right, that's grown up over, certainly since your great-great-grandma, who was it? You read the $20,000 check? Great-great-uncle? I mean, there's a whole industry in M&A, right? All the investment bankers out there working with all these big companies, pushing them to have, you know, M&A departments, you know, life out there buying all these companies. I think the reality is, I look again over, you know, my practice over 25 years, the companies that are doing well get bought. It's just rare to have a company stay private and just grow over time. If they're doing well, they're generating some good income, some banker hits them up and does the calculation for them with the multiples and the capital gains rates, and they end up selling. Again, there's exceptions, but I think by and large, we're seeing that's probably what's happening.
I think one of the keys to having a company that's long-lived and having a legacy is the management team has to know when to get out of markets and to get into new markets. So a company like ours has very slow growth parts of the company and very fast growth parts of the company. And really good management teams know when to prune, when to divest things, and know when to take leaps of faith and buy into new areas. And you know, a great example that I'm sure everybody's familiar with is IBM. So IBM used to be making a lot of its money on mainframes and computers, and you know, they at least had the foresight to figure out that if I'm not a solutions and services company, then I'm dead. And so IBM is still around and is still a powerhouse because management made a really fundamental shift about what markets they needed to be in, and they set themselves up for success. So, you know, I really, when I talk about, you know, we want to be on this red line and kind of be there, you know, our management team very much has that mindset, which is if we just stay in our current businesses, we're probably not going to be on that line anymore. We will get bought. Even at the size of 10 billion, we will get bought.
Or your business won't do very well and you won't get bought and you'll end up like Eastman Kodak.
Yep.
Which, you know, is sort of a sad, you know, situation to see. I mean, what a legacy, you talk about a legacy. I mean, for me to look, you know, I look back when I started at Eli Lilly and Company and I was 21 and I was right out of college, and to work for Lilly was just like huge. I mean, my wife's family were all doctors. You think your kids grow up to be a doctor? We were the successful couple because I worked at Lilly And it was just a huge thing. Lilly and Merck were the two big pharma companies. And back then, what they were really concerned about was they really focused on what's the best thing to do for the patient. And I watched that, and I was there for 20 years, never thought I would leave, and then I had a chance to leave, and it worked out well that I did. But I watched, the shift move away from, why were they in business in the first place to this very short-term, look at each quarter. And I think a lot of, just the internet and the instant communication that you have, I think really has hurt some of these companies when you talk about legacy, that's just everything is so focused on the next quarter, and they really don't have that longer term look, and I think, or they don't, adapt like IBM did, or you look at Hewlett-Packard is a good example right now, where Meg Whitman's really tried to take this company that's a little bit struggling. It was such a powerhouse, and trying to figure out, which is the right direction to go in right now. It's going to be interesting to see how that rolls out, I think.
So this is probably for Jeremy and David. You're an advisor to a company that a personality like Larry Ellison was mentioned, or Zuckerberg, found out maybe there's another controlling person there, wants to take over, but with some performance requirements, so it's not a straight outright, but they want the founders to stay on. What would you recommend?
So I'm gonna start by saying this. I've probably been involved in a couple of hundred M&A transactions over 25 years, and I've actually gone back and went over this because I've tried to do this for my clients. I can't come up with 5 where the founders stayed at the company more than a year. But then that first year following the M&A, and again, remember, I tend to work with entrepreneurial companies. The founder is the guy who started it, or the woman who started it. There's a lot of passion about this company. They run it themselves. They've really never been an employee. I can't tell you how quickly I get that phone call. These guys are jerks. I got to fill out a requisition form to get pens and paper, right? I've got accountants, all over me. It's incredible how quickly. So if so in your example, going into it, you've got a difficult person who's going to be running your company and buying over time, don't do it. Unless
Well,
you're
get
getting
all
paid,
the cash
unless,
up front.
Yeah, unless you're getting paid so much money that you're just going to walk away and forget about it. But if you think you're going to stay there and do an earn out and earn over time,
Qualcomm's
it's going to be a
acquisition
nightmare.
of Larry and put in a longer than a 1-year period. The founders had to stay. So I'm sure the acquiring company.
They have earn-outs, they have long-term employment contracts, and the founders don't stick because they can't take it. The big company can't manage them, and they can't stand being managed.
It's really, if you do an earn-out, it's really important to have a great lawyer in your transaction, and that your corporate lawyer, someone like Jeremy, worked side by side with his litigator to prepare the document for the litigation you'll be entering into down the road. Have you sold an earn-out?
Totally true.
Okay. Do you ever buy?
We do earn-outs all the time.
And how many have you litigated?
Probably 50 to 75%.
And if not litigation, there's certainly disputes, battles, arbitrations, back and forth. Lawyers are involved. They're complicated to draft, and they're very expensive to get paid out on.
Just so Jeremy and David don't have all the fun, I'll direct a question to the other pair. Jeff, I guess, first. What is your understanding of under present day conditions, what percentage of acquisitions are failures? And has that changed over time?
I read the same.
All of Life Technologies works. He can't say that.
I won't speak to life, but we aren't successful in every single one of ours. But generally, if you read the trade journals, it's anywhere from 60 to 80%. Now, how people define failure, I don't know. We have deals where we had a revenue model and everything's hitting 90%. Some people might say that's a horrible failure. Some people might say it's perfectly acceptable. You're not going to get everything right. From a VC perspective, these guys have much high failure rates. If for every 10, if they get 1 Google, they're probably really happy. That's not the type of mindset that we have. That's not the type of mindset we have as a strategic acquirer. So we're probably looking for more like 9 out of 10 work as opposed to the inverse. but we're also not buying early stage, non-revenue generating things. That being said, a company like ours, if you're familiar with what we do, we have bought a pretty expensive technology in DNA sequencing. It was a very big bet, and it's doing well, but if we did 10 of those, we're not going to expect to hit 90%. So, but again, I mentioned it in my earlier response, because a lot of people buy companies and then they don't integrate them well, and they're not serial acquirers, there's just a lot of experience and knowledge that's created when you do this multiple times in a year, and the personnel internally understand where to miss things and where to uncover things and how to execute on things. I'd say the people that don't do this a lot, the failure rates are much higher, and a 60 to 80% number wouldn't surprise me in terms of things that just fail.
The actual number is about 2/3 fail, and the quip is 2/3 fail, and the other 1/3 they lie to you.
And how would you define the failure? That's the part.
The failure that, at least in finances, that the acquirer's stock price after the acquisitions for a few months or so does not seem to be going up. That's one sort of definition. And something else that Jeff pointed out, the biggest reason for failures is lack of integration.
Yeah,
execution is the biggest problem in
I got to jump on that. I think Jeff is hitting on such an important point. We talked earlier about the story I was going to share with you about this internet IPO I was involved with. I'll just tell you that this company did end up failing, ended up being sold on about 10 cents on the dollar for the money raised. But the company did 2 acquisitions leading up to its ultimate failure. And what happened with those acquisitions was that they were not integrated. And we ended up literally having 3 different technologies, one serving our own original customer base, and then one serving each of the other 2 companies that we bought. And the technologies were never brought together. The engineering team was never brought together. These things operated completely independently and stayed that way. Disaster. And I can see Patty, who worked at the company, has firsthand knowledge of that.
And I will say this, you have to be very careful about how you integrate companies. We did buy a company with a very entrepreneurial founder, and if he went through the traditional, you're going to be integrated, you come into the system and fill out requisition forms, we absolutely would have squelched the company. So, I'd say for most of our acquisitions, we integrate them into the fold, and if the founder leaves, c'est la vie. But for other acquisitions where, the science and the innovation is really in an entrepreneurial culture, it doesn't fit well with a $10 billion company. So you actually have to take a very, purposeful approach and keep them away. Keep them away from bureaucracy. Just give them a check as if you're domain or whatever. You just let them spend money a little bit more willy-nilly than you might normally do so for the rest of the business. So you really have to be careful about when you are, if you are exiting into a big company, you want to talk to the acquirer about the integration approach. If you're more of an entrepreneurial mindset and you do want to stay there, maybe you do need to be outside the mothership. But if they're going to extract value primarily by sticking you in the channel and being in the IT systems, to Jeremy's point, the founder's gone after a year. He's not dealing with that type of integration. That's just not the kind of person that built that company. They're not going to last.
You need advisor right.
Other questions? Anybody else? Okay, I have a couple. So Randall, how does an exit strategy impact your choice of investors?
It probably goes back to the point I was talking about earlier. I'd rather have a group of investors who are very experienced and experienced probably solely in the life science area because they get it, how difficult it is. I think to pick somebody, or the problem you have today is that people do pick people that don't fall into that category because the resources are so scarce, and then it becomes difficult. But yeah, if you can do that, that's probably the best way to go.
Well, we were talking right here at dinner, Randall, about how, because of the way you're exiting now out of these, the biotech companies in particular, that the VCs really, they don't want to play the cash flow game, right? They all want this exit, so
yeah.
they sort of don't fit anymore, right? It's sort of, there's a real issue now about how you get funded. What kind
Yeah.
of investor?
And you know, no offense, David, sometimes I say, you know, that there's not a lot of venture left in venture capital sometimes. It's, you know, we hear a lot, you know, because what I'm trying to get started right now is an earlier stage company, and that's a really limited universe of venture groups as opposed to a few years ago. And, you know, a lot of the folks, they want the later stage, you know, less risky investments that probably have you know, a greater chance of exiting or being acquired by someone. They really don't want to take the risks. And I feel sorry for some of the newer guys who, if they haven't had a track record of being successful, it's really difficult to get some of the venture folks to pay attention to you. If you haven't made money for them before, don't have a reputation of doing that, if it's your first time out, it's next to impossible to get money.
David, you want to give some advice to?
No, I think you have to, 25 years ago, the venture capital industry was even smaller than it is today and smaller than it will be tomorrow, and was dominated by people who love to build companies. Venture capital is an asset class. You have firms raising $1 billion. Their sole objective is to make money. You build a company doing that, great, but the reality is, I think Henry said it well, you know, that you want to find people who understand your business, who have a common viewpoint to the world. You know, I'll pick on Sequoia for a moment. Sequoia is one of the 3 or 4 most successful venture firms in the country. They don't stick through thick and thin. It gets thick, they're gone. It's a great strategy for them. It's worked really well. But maybe it doesn't work for you. You know, so I think knowing who your partner is, because more, you know, I get entrepreneurs say, oh, well, why should I have you? You know, are you going to be fickle? You're just going to get out of this? I said, the odds are high, Mr. Founder, CEO. I will be with this company much longer than you will.
Which, of course, is why most founders are afraid of getting venture capital.
Yeah, there you go. I've, in fact, never had a company where I got to quit before the founder did. I've had founders quit before I did. I have had founders thank me for firing them to put them out of their pain. And I had to go in and explain on Monday to my partners why we had to put more money in. And I took their pain on my shoulders. So I think getting someone, understanding it's a partnership, is a real, if you think of them as only money, you're both going to be frustrated.
Okay.
I wanted to bring out the point of hostile takeover. We are following this story in San Diego area, Illumina and Roche. And I guess that's a question for you, Jeremy and Randy. If you were Illumina or Roche, how would you go about doing it?
Okay. If I can just make one quick comment before Jeremy does. If I were Illumina, I would never sell to Roche, but that's because I've experienced being taken over by Roche. So.
But you'll be open to another partner. Anyone other than Roche.
So,
Are you conflicted, Jeremy?
No, I'm not conflicted. It's just that there's a really complicated, and the problem is there's so many different options when you're talking about a hostile situation. So anything I would say could be sort of too simple and too flippant, right? But in general, when this kind of thing happens, the target company is a goner. It's just a question of who. It's not Roche, it's going to be somebody else. There's going to be a white knight or some situation. It's just rare that you get to this point and that company stays independent.
And why is that? Because directors don't like being sued. And so when someone comes in and says, we'll pay you a 30% premium, the company's gone. It's the beauty of being a private company. Someone comes in and makes a stupid offer, you can still say, no, we're not selling. But if you're a public company, you have a constituency to answer to. And that constituency isn't just your shareholders. It's every tort lawyer in America.
There's some truth to that. I mean, I don't want to get into the legal stuff, but I'm not trying to defend tort lawyers, by the way, because believe me. You actually can say no, even as a public company, and there's actually Delaware cases to that point. But I think it's actually more sort of tied to what's happening in our financial world. What happens in this situation is the shares move, the shares get hot, and they end up in the hands of basically hedge funds and ARB firms, and so it's over. They've made their investment. There's going to be a deal. They're going to get their return, and that's just what happens.
Yeah, last question. Not, oh, go ahead.
Hearing no other. Those of us like Jeremy and I who are really old remember that you're not as old as I am. Sometime back in the real old days, acquisitions were often done with acquirer stock. Now they're all for cash. Does this group think that is going to come back in any kind of near term or mid-term?
I mean, from our perspective, cash is very cheap. The debt that we raise is very cheap. And we are so maniacally focused, most public companies are, on EPS. And so it's just more dilutive to our EPS to issue stock to a founder than it is just to pay them cash and to borrow it from our revolving facility at 1 or 2%. It's very similar to the situation everyone probably has with their mortgage. It's just very cheap money nowadays, and it doesn't make sense. And the stock price, our stock price the day after an acquisition, will react differently if we did a $300 million stock deal or a $300 million cash deal.
How many of you would like to own Skype for $87 million a year? Oh, come on. The thing generates $500 million of profit. You wouldn't like to own it for 87? That's what Microsoft paid to buy Skype. $87 million a year. It's nothing. Why? Because they spent $8.7 billion that was going to earn them 1%. With cash that cheap, you know, it's so cheap for public companies that are sitting on tons of cash to buy somebody right now. That's why they're paying in cash, right? I mean, $100 million costs you $1 million of earnings. He knows this number.
It's cheap.
Last question? If not, let me thank the panel.
Everybody on your way out, there's actually an article that I recently wrote about selling your company and some of the things you need to do to sell your company and get it done this year. It's actually out on the back on the table on the way out. Please grab one. I think you'll find it very interesting. Thanks for coming, everybody.
Yeah. That was interesting.